Hey, have you ever wondered what credit score you need if you want to buy a house, how to fix your credit if you have bad credit, or just where to get started when it comes to credit repair? On today's episode, we'll be featuring my friend Anselmo Moreno with Innovative Credit Solution, 16 years of experience, and all the knowledge that you need. Tune in, let's go. All right, guys, welcome back to another episode of the Real Talk Podcast. I'm here with my boy Anselmo. What's up, bro? How's it going,
man? Thanks for inviting me, dude. I'm excited.
I'm glad you're here. We have tons of things to talk about. I think it's limitless what we can talk about, right?
Yeah.
But let's go ahead and get started, bro. What do you do? What's your profession?
So I'm a credit consultant for the last 16 years. Sometimes I lose count. I've been helping people just navigate credit issues, right? So a lot of people say, well, what exactly do you do? You know, they call us and they have that inquisitive mind. Like, how does this work? And so what I really like to say is I help people understand their credit and their options so they can make better choices for improving it, right?
Yeah, there's no sense in fixing your credit and then you go right back to where you started, right?
We used to have this old analogy that, used to say, well, we can fix the car, but if you don't fix the driver, right, the car's going to keep messing up. And so it's a similar concept for credit.
Sorry to cut you off. How often do you get like repeat customers? Because I don't think you want to see customers.
Yeah, man. So you know what? Now on our 16th year of business, I get them often, and it's something that I just kind of sometimes becomes funny because it's like, hey, you're not supposed to come back. We don't want repeat customers. But what I've learned is that life happens, right? I've had people come back where they get divorced and they both come back. Like, oh, we're divorced now. And obviously they come back at separate times. But technically, people come back because life happens. Job loss, layoff, divorce, just life happens. And sometimes credit issues come up and we can help them understand their options and how to navigate it.
Well, that's the beauty of what you do, right? Because like you said, life happens. So when life does happen, that could be divorce, that could be I lost my job, I don't know, whatever.
Medical condition nowadays, exactly. Right?
Yeah, so with all that, there's, if it's either feeding my family or pay my credit cards, I'm probably going to feed my family first,
Yep.
So that being said, how long, you said 16 years?
Yep.
So how big is your company now?
Yeah, so Innovative Credit Solutions is the company, and the company started in 2006. So let me give you the origin story. So I started working for a different credit repair company in high school. And at the time, I didn't really understand what I was doing there, but I had a skill in typing really fast, and I was bilingual. So I got brought on.
How many words you type per minute?
Like 110.
Damn.
Yeah.
I remember when I was sorry to pause that, but I was getting my previous job and I was struggling to type 40.
Yeah, no. I was pretty wicked with the keyboard. And so, boom, they brought me on. And so I started to understand like what the company was doing. And so I learned credit, and then I stopped working there pretty quickly. Maybe I was there a year and a half. And then I started to go work for a collection agency because in my brain, thought that I knew everything about credit. And so I started working for a debt collector here in town, HP Sears. And so I was there for about another year and a half. And then I thought I knew everything about collections. And so that's kind of how Innovative Credit Solutions was started. And that's where I met Richard.
Okay.
So Richard was a debt collector there, and I was in sales there.
So for those of you who don't know Anselmo and their company, Innovative Credit Solutions, he's your one partner, right?
Correct.
So it's you two.
Yeah.
Richard David.
Yep.
Yeah. Richard David and Anselmo Moreno. They're both the co-owners of Innovative Credit Solutions. So you guys met there?
That's where I met Richard
okay.
at Innovative Credit Solutions, and so at HP Sears.
Okay.
And so we started. He was a debt collector.
So you guys
sales.
went from charging people to helping.
Yeah. So it's interesting to think of like sales for a debt collector, because what I really did was I went out and I met with like companies that people owed them money to, body shops, doctors' offices, dentist offices. And I went there and said, hey, anybody owe you money? Give me the accounts. I'll take it to my crew at HP Sears and we'll get the money for you, right? And so that was the gig.
How does that work? Just to get very, very like slightly, how does it work? So if I'm Citibank and I hire you to collect that payment, do you charge like a percentage of the amount or something? Yeah,
it's called Contingency Collections. That's so a lot of people think debt gets sold, and debt does get sold, but that doesn't mean every debt gets sold. So here locally, or in most places, local debts are going to be assigned on a contingency basis, and that means that you don't pay anything until the debt collector collects, and they keep a percentage out of it. The percentage is negotiated based on volume and quality of accounts. And so that percentage can be anywhere from 15% if you have a massive hospital sending you massive amount of accounts, or 50% if it's just like a small body shop sending you bad checks or something. And so, so that's kind of what the gig was. And it was pretty cool. I really enjoyed my time there. I think, as business to business sales is kind of where I learned and developed sales skills. And I was an outside salesperson, right? Because I wasn't in the office selling. I was actually going
pretty much knocking
clients.
Doors at businesses.
Yeah. And so, so that's where that gig was. And then I knew that I can help people fix their credit. And I want you to like envision this. So this is where it was. It was 2005. The real estate market was peaking, like it was going crazy, right? And then we were going to 06, and I was at HP Sears, but people were calling me from my other time at the credit repair company because I was bilingual. I spoke Spanish, so they were calling me. Now they knew I worked at HP Sears, and they were trying to get HP Sears stuff off of the credit report. So I was still fielding calls for like credit repair type help. And that's really where the idea for Innovative Credit Solutions started.
Did you have that control to?
Yeah, we could do that. HP Sears was a big, small company, so we could do that. Now, and that's where Innovative Credit Solutions started. I eventually was like, well, I'm going to start my own credit repair company, and I did.
Been booming ever since.
And so it was not quite. I went through all the struggles that any young business owner will go through. Made all the mistakes that you're supposed to be making. And so.
Well, there's no other way to learn, right?
Yeah.
So you can coach me to do something all you want, and if I don't experience it, it's like.
So after all, but that happened, and then the real estate market collapsed, and there was a serious demand for credit repair in 07 because lending guidelines started to get really strict. So they started to be really loose, and then they're just like, the threshold is now this higher credit score. So we started to figure out credit at that point. And sometime in 08, I hit up Richard like, hey man, you got to come help me out, and
so you started it by yourself.
Yeah. And so Richard kind of started to see the potential. And so then kind of that's kind of where he came over, and we started to just slowly build it up. And one of the first contacts that we made was with Signature. Okay. One of the very first like big, relationships that were developed was with Signature.
Who was here at the time?
Kelly.
Just Kelly?
Craig, Joe. Yeah. I mean, and Richard really built that relationship over the years, and I mean, man, it's.
Well, that's how I heard of you guys.
Yeah. And it's countless, like the amount of people that we've helped jointly over the last 15 years or 14 years.
I mean, off the top of your head, how many people do you think you received from here?
I mean, over the years, it's got to be over 1,000.
Yeah,
I'm sure. Because it's just the amount of loan officers you guys have, right? So you guys are really big, and you guys have a lot of LOs, and then everybody sends them to us. So I mean, it's a very valuable relationship.
Well, because for people that don't know, see, like we see this on a day-to-day basis. So a lot of the stuff we talk about is common sense, and to us. So it's like, how do you not know that, right?
Yeah.
But what a lot of people don't know is that like everything is credit score based, right? Like you go buy a car, you go get a credit card, you try to buy a house. Everything depends on your credit. You have low credit, higher interest means you're giving away more money, right? So a lot of times when I have a client that's out of, let's say, a 640, we both know they can buy at a 640, but their rate's going to be way higher than if we get them to a 680. And when you analyze the credit, you're like, hey, well, it only takes this, and they'll be at a 680, and it's not going to cost much, whatever. And so then a lot of time we'll send them to you guys to get it done, and the client might be like, why would I fix my credit if I can already buy it, right? But like, can you kind of like explain how simple it can possibly be? I mean, I know it gets very complicated, but there's cases where you reply to my email and you're like, hey, no, this one's easy. In a month they're done, and I'm like, oh, okay. So like how I know it gets complicated and it gets simple. So I guess like just
so there's like levels to complexities of the credit score range, right? So if somebody has a 640 or even a 660, their credit is not bad. There's got to be something there that's holding them back. You can't have a 640 and have like a recent repo. You can't have a 660, and have a recent late payment.
A lot of times I look at a credit and they're like at a 702, right? And they have years of because to be in 700 you have to have history.
You got to have a solid history.
So
and
I'm like,
no recent delinquencies.
Yes, exactly. So then I'm like, why are you at a 702 when you have $10,000 credit cards that have zero balances on them? And then I keep looking, and they have like a late payment 2 years ago. And I'm like,
Yeah.
if it wasn't for that late payment, you'd be easily 750 above, you know?
So sometimes we look at it and it's something super simple, and it's something that, and hopefully we can get rid of that myth today, at least for your listeners, that medical debts don't matter, right? And those are going to be probably like the first frontier for holding people back on their credit score, because they have this mindset that they've been fed that say, well, ignore medical collections. They technically don't have to be paid in order for you to get a home loan.
So if we're on that topic, on my end of things, it's okay. What they mean by they don't matter is we don't have to take the debt obligation, right? So any other collection, we have to use 5% of a total amount, right? So medical collections, we can ignore. Now, they're keeping your score down,
Yep.
but we don't need to use the obligation. That's the only thing where people say they don't matter. They matter.
Yep.
But we don't have to use the obligation. So just to clarify that.
And so, but that obviously gets interpreted incorrectly, and then so people, the last thing that they look at is, well, I'm going to deal with these medical collections. The medical collections could be $50, they could be $500, but they could be the difference between a 640 and a 680, right? And so oftentimes when you send me a file and I'd say, hey, this is pretty simple, it's because I've identified quick removals of these medical collections that are probably small, and we can remove them in a couple of weeks, and then we can get the brand new score.
And with the experience you have, you see a collector and you already know that they're negotiable, right? Like,
right.
I can hit this one up and they'll get it done.
And it's HP Sears.
Yeah. And then you see another and you're like, oh shit, I don't know if we can get this one done, you know? So I guess that leads to a question I was going to ask was, what would be the difference? Obviously, this is a very simple answer, I think. But what would be the difference between working with someone that just like does it part time on the side, or they just kind of, because there's a lot of those, right?
Yeah.
There's a bunch of those. I didn't know about it till I got into the business.
Yeah, man. So credit repair is interesting, and I've seen it kind of grow into. We've had a lot of new actors come into the business, and you know, I think locally our reputation is unmatched. It really is, just because of how long we've been doing it. But we have to understand that credit repair, what most people think that credit repair is that you write these mean letters that quote all these laws, and that you send them to the credit bureaus and cross your fingers and hope that everything that you're disputing is removed from your credit report.
Chew some gum, put it on, and hope it sticks. Huh?
And so the majority of credit repair companies, you know, big or small, what they're doing is they're sending out these letters on your behalf. I've had clients that say they sent me the letters and I had to mail them off. And I was just like, wow, I mean, so you're doing all the work technically.
Yeah,
all they're doing is copying and pasting letters, putting your name on them and sending them off. So that has severe limitations of just what exactly it can do. That it's going to work. And so here's kind of where things trip up. It'll work if you're disputing an account that's over 7 years old. For sure, it's going to work.
Because it has to come off.
Because it has to come off, right?
So you could have done that without the help of anyone.
Correct. And so most people do. I mean, most people can dispute things on their Credit Karma app real quick. Most people actually do already. And so, but that's technically what the majority of either new credit repair people are doing, or even established credit repair people are doing. They're just sending out strategic letters that are supposed to just dispute things on your
Quote
credit
unquote.
report. Yeah, but you know, for the most part, these are all form letters being recycled. And so at HP Sears, we used to get the letter, and you know, I'm like, man, this came off straight off of Google. Like they quoted all the wrong laws, and no real consumer is going to start quoting laws like that.
For the most part, the person reading that letter is a human being. So
yeah,
you can tell when it's BS, right?
and so you just know that letter has no teeth behind it, right? But the law is very clear on what they got to do, so you don't have to get all fancy with it, you know. But for the most part, that's what you're paying for. Technically a letter service. And you got these big players like Lexington Law that they pretend to be lawyers. They're technically owned by lawyers, but they're not really intervening legally for you. And so what they're really doing is just sending out these letters. And creditors are already used to receiving them, and they're not going to necessarily take any extra measures that they would if you were sending the letter out on your own, right? So that's really the main difference. And it's important for people to understand that credit repair companies, what they're doing is they're sending out these letters, and they might try to oversell them that they're these amazing legally written letters, but the reality is that they're not, right? And they're being recycled and reused for a monthly fee. And that's the big difference as well, is that we don't have this ongoing indefinite monthly fee, right? So most people, when they ask us for credit repairs, they say, well, what's your monthly fee? And I just say, we don't have one, because we don't. I've had people that say, well, I've been paying such and such credit repair company for a year and a half.
We know what companies
the monthly fee, right? And I'm just like, that sucks, because credit repair is supposed to be like a project where we know what exactly we're going to go in and do, figure out, and then resolve.
So technically, and I might be wrong on this. It's a question. If I need credit repair, right? I go to you. You're going to charge me a fee to get the service done, right?
Right.
Let's say you can't get it done. Do you still charge me?
Good question. So technically, no, we won't. But there's circumstances where that something like that's going to happen. Let's see if we can dissect that a little bit. So you cannot fix somebody's credit if you don't have a plan for the debts. Most people that have bad credit have collections. So if you're starting to dispute the collections and the debt collectors have all the proof of the collections, then what? And that's what separates real credit repair from pretenders. Okay.
Actors.
Because what they're doing is, if the debt collector comes back with all the proof, now what? The debt collector's like, okay, I got all the proof that you're asking for. This is your debt. And you wrote me this fancy letter saying you needed proof. So here's the proof. Now what? So if you ignore them after that, you've triggered them to sue you. And that's another big potential point of pain for consumers, is that you can actually get sued for debt, and then they start to garnish your wages, levy your bank account, put a lien on your property, and things can get really ugly.
So in a sense, collectors kind of want you to send that letter sometimes, right?
The biggest rookie mistake on this letter, and so hopefully I can communicate this point. The most common letter that we have in the business is called a debt validation letter. And as a debt collector, if you receive that letter is demanding proof that the debt is valid. And the one that is on Google, if you Google it right now, it's going to have language in there that also throws in what's called a cease and desist communication to the debt collector. There's a part in the debt collection law that says if you request that they cease communication from you, the debt collector is prohibited from contacting you by phone or at your place of employment, or in writing. Right. So you've ordered them to stop talking to you. So then the only method that they have to communicate with you that is allowed is by suing you. Oh. So if you send this fancy letter out and it's got that cease communication language in there, you've only left the door open for the debt collector. All they can do is sue you. And then people get sued, and then, and then we have to. So things just kind of spiral out of control. But, back to the point is, you can't have a plan to fix your credit if you don't have a plan to deal with those debts. We are extremely good, because of our debt collection background, at dealing with those debt collectors. Sometimes we got to make a deal, and the deal might involve paying them some money, but our job is to save you as much money as possible, and our job is to negotiate that the account get deleted off the credit report.
Well, it's because, realistically, you owe that money. You do,
Right, but there's circumstances where they may not have to pay it. The debt might be too old. We might be able to get their health insurance to pay for it because it wasn't billed correctly, right? The debt might be more than what it should be.
And you guys take care of all of that?
We can help with that. So in circumstances where maybe we are not able to do something for someone, it's not that we weren't able to do it, but the negotiation didn't go the way that we wanted it to, right? So we wanted to settle it for 30%, but we only got it to 70% or 60%, right? So that could be a situation where maybe the objective is not met how we wanted to.
But where I was getting at when I said you owe that money anyway, you owe that money, right. Is where I'm getting at with that is if you guys even drop it down to 70%, which is not you usually drop it down much more from what I hear, right?
Yes.
But let's just say the worst case scenario, it's 70%. It's still saving you 30% of money you owe. You got in that debt. Well, and if it's medical collections, those are tough because you didn't choose to get sick.
Right.
Those are tough. But credit card collections, repos, stuff like that. You chose that. So if you can save them 70 to 50 or 80% or whatever it is, that's already a win in my book.
But it gets a little bit deeper. I know what you're saying. We're not the moral police. I lay out the option. So if we know that this debt is valid, they've proved it, but we also know that the debt is going to be 7 years old in August, and I gave the client the option. Do you want to buy before August, or do you want to wait it out till August? And then so they'll, nope, I'll wait.
And then in August, you just dispute it. It's 7 years old.
Correct.
Take it off.
Correct.
Gotcha.
And so we help people plan to make these decisions. And sometimes, nah, man, I'm living with my mother-in-law. I got to move ASAP. I'm not waiting till August. And then, boom, we jump on it, get it off the report. Or they might be like, no, I'm cool. My lease is not even up till September. So
what's wrong with living with your mother-in-law?
Hey, I'm just saying, I'm giving examples of stuff that has been said to me.
No, all right. So let me ask you something. We already talked about working with actors, right? Now, this is very, very, very common. It's happened amongst our mutual clients. You give them, I guess you would call it a diagnostic, right?
Yeah.
Of what's wrong and what you need to do and the consultation. And they decide to go and try to do it themselves.
Yeah.
This happens very, I want you to really, really explain how that is probably the dumbest thing you could do when you're trying to fix your credit.
For sure. So certainly you need to understand that some of these negotiations can only happen if we're at the forefront, because the relationships we've developed with these debt collectors over the years helps the deal go through, right? If HP Sears knows I'm calling, they know I'm calling with money. Like, I'm calling them because I have money for them, right? So we can pull strings for you to get stuff done. So sometimes people think that they could do it on their own, and so I would caution them, because A, not only do you need to negotiate that the balance be less, but B, you need to negotiate that they remove themselves from the credit report completely, and so that's a big roadblock that they could run into.
But aside from that, and correct me if I'm wrong, they log your calls, right? So you call and say, I know I was late, but I want you to delete it. You're totally screwed because you already accepted.
Oh, I see what you're saying.
You get what I'm saying? Like,
yeah. So late payments are some of the most difficult things to remove from a credit report. I mean, that is something that is extremely tough. If you can't remove a late payment from a credit report, it will stay on there for 7 years, right? But for the first 2 years, it really, really hurts your score. And then after 3 years, it starts to hurt less and less. But technically, a late payment will be there for 7 years. So yeah, if you call the debt collector or the bank and you say, hey, my bad on this late payment, and they ask you what happened, and you just say, I forgot, or I didn't have the money, like you have zero chance.
Because now they log that you accepted that you were late.
If we always have to make a plan, like a plan, and the plan might be legitimate. Like, there was a legitimate family catastrophe that stopped you from paying. There was maybe a fraud that happened to your bank account that stopped the transaction from going through. One that's been working is the rise in mailbox thefts, when they hit the community mailbox and nobody got their statement. If we can log that there was a police report filed and the dates match, that's a late payment that's coming off.
It's crazy. Richard helped me with one a couple years back. We run at the end of, right before closing, we run what's called LQI, and that tells us if they have any new debts. Well, we go to run this, and our borrower's credit dropped by like 80 points. 80 points, dude. And this was just for one late payment, right?
One late payment will do that.
Richard's like, I think I can do it. Possibly, let me call, whatever. Borrower saying, I wasn't late. It came out on auto draft, whatever. And it didn't go through because the debt collector told Richard in a letter. I read the letter. I was like, damn, that's crazy how detailed they are. It's like a big old paragraph of like, okay, we called this person, told them, hey, your auto draft is scheduled for 150. The payment's 152.
Dang. And
she's like, oh, no, I don't want to do it. I already have it on auto pay. It's an honest mistake, right? Like, someone calls me and then all this fraud stuff, like, it makes sense. I'm going to ignore you. My payment's on auto pay. Why would I make a payment with you? And all right, cool. They hang up. They call again. Hey, your auto pay went through, but you owe us $2. And this person is like, no, it's on auto pay again, right? Okay, boom, bye. So that's what they said. Like, we warned this person multiple times that they were going to be $2 late, and it was a late payment for $2. For $2, this person had to cancel escrow because they're paying the credit dropped by like 80 points, so they didn't qualify anymore.
Talk about bad timing, man. And that $2 mistake probably cost her tens of thousands now in equity on that property.
Well, they ended up buying.
Oh, good.
About 8 months later. Late payment's still there.
Yeah, but it hurts less.
Yeah, exactly. But late payment's still there, so that means credit's still lower than they were. We're talking this person was in the 700s.
Yeah.
Dropped down to low 6s, right? So low to mid 6s. So higher interest rate, no more down payment assistance. So it costed money.
That $2 was pretty expensive.
So again, it's an honest mistake, but it happens, right? And this exact situation, I don't know how many times you run into these. I mean, that would probably be very, very, very hard to get that again, right? But this stuff happens. So what I'm getting at is these debt collectors, these banks, they're not dumb. And they want their money, right? So if they can find a reason to charge you more, it's like, I don't know, I think Bank of America, you might know the number of money that they make on overcharges.
I don't know the number off the top of my head,
crazy.
But it's serious.
It's like billions of dollars a year. I was like, what in the world? And like that's stuff that, again, there's obviously life happens, but most people are just ignorant to it, right? Like, I don't want to put money in my bank account. I'd rather have it in my house. And then they're overdrafted 3 or 4 times a month, and that's what, like $90.
Yeah,
and
it's, I don't even know how much it is anymore, but it's in the
30,
30s.
I think $35 to $40. It depends on your bank.
I mean, that keeps going up. I remember it was in the 20s.
Yeah,
so
I remember being young and always being overdrafted. I was paying more in overdraft fees. I would get paid, and half my check would go to overdraft fees. I was a kid, but still, you know.
Yeah, man. And so some of over the years, credit reporting and credit repair has changed a lot. Removing late payments before in the mid 2000s was cake. I mean, it was just easy peasy. It would always happen. And as the government started to just develop in more stringent procedures, and the Consumer Financial Protection Bureau was developed. They were launched in 2010. It's a new government body that governs credit repair, credit bureaus, debt collectors, banks. We started to see companies become what I call hyper compliant, meaning that they want to be by the book 1,000%. And removing a late payment is not technically by the book, right?
Yeah, because, and then again, like you said, they want to be 100% by the book. Aside from the laws, to be by the book, they log every single thing that happens.
So they have these they have these positions called compliance positions, and what these compliant positions do is they just make sure that whatever they're doing is by the book. So if you are requesting a late payment removal, and the compliance person looks at it as like, this is not by the book, it's going to be very hard to get it over. We've found ways to make it by the book because we understand what's happening. A by the book late payment removal would be because you were in a natural disaster, right? So when the last hurricane that happened in Texas, we had a few clients that technically were in Texas at the time, and we were able to petition to have some of these late payments removed. The last fire that happened up north in California, it was declared a natural disaster by FEMA. We had some clients that were visiting up there, family, and they got stuck, and they were in this natural disaster.
Well, it's because you've been on both sides of this table, right? You've seen what it's like to be a collector or working for late payments or not collections. But what I'm getting at is your experience on both ends is what makes you guys so good, because you know what way to angle and how to target different situations, because you've seen, no one has seen it all, but you've seen the majority of it.
It's extremely rare that I see something on my desk that I've not seen before. It happens, but it's extremely rare, right? And late payments are some of the tougher stuff to get through. I'll look at it and I'll know right away if it's a project I want to take on, because I'll know the probability of success. And I'll be transparent with the client, like, hey, this is not going to work. We don't have the angle. The things are not lining up. And I'll tell you, the more consistent times that it doesn't work is when the account has a history of lates. If there's been lates throughout the life of the account, we stand no chance. If it was a one-time late, it's a pretty good chance, right?
So let me ask you something. Let's just say, like, does COVID help anything? Like what happened with the pandemic and stuff? No.
It really doesn't. We thought it was, but the reality is that it actually made things very difficult.
Because people make so much money in the last 2 years.
You know what got really difficult is negotiating. We used to get some killer deals pretty easily all the time, and now we're having to fight tooth and nail to get the same deals.
Because like we mentioned earlier, the person on receiving these petitions, it's a human being who knows that people have money. Honestly, it's funny to say, but people have made so much money these last 2 years, and I don't know about but had so much money that it was like, I know you have money. That's why you're trying to fix your credit.
Yeah.
Like, don't try to negotiate with me. Like, even the car business. I just bought a car the other day, and I just happened to know, I used to work at Dodge. So I was talking to the sales manager. He tells me, like, dude, it's different now. Like back then, you can come here and try to negotiate. Now we know everyone has money. So when you come, you can't try to be, it's because I don't have the down payment. Yes, you do. Now it's starting to get away from that. Like, people are running out of their COVID money, I like to say. But I mean, it goes hand in hand with that. Like, why would they give you a 50% or 80% discount, as you would say, when they know you have the money? So you want to fix it, it's going to cost you this much. If not, then it's up to you.
So one of the things that sometimes becomes tough in negotiating is that the debt collector can see your credit. People don't understand that. So they can see the mortgage inquiry the last
Current
week before.
credit?
Yeah.
Wow.
So as a debt collector, we can see your report. And I can see that you applied for a mortgage last week, and it coincides that you called me this week, right? So we can lose leverage.
So let me hold you there. So in a sense, is it better when let's say you're my client? Hey Edgar, I'm trying to buy a house. Cool. Should I ask, like, what do you think your credit is? If they tell me I'm under 600, should I send them to you before I even run their credit?
I think the real question is, do you have big collections? Right, because if you have big collections, and big is anything over $2,000. If you have anything over $2,000 that is in collections, whether it's a big credit card that you stopped paying 4 years ago or some type of repo, whatever, those are the ones that we don't want the debt collector to know that you had a mortgage inquiry, because we will lose leverage in the negotiation. So, yeah, that's really the question I would want you to ask.
Many people don't know, honestly. They just think, because some people think I just stopped paying it. I don't know what collections are like. Because that's the thing.
Yeah.
Right. So they don't know. So I guess that because I've done that already in the past. I know that an inquiry can drop their score, and I don't know how significant it is. I think it varies from person to person, right?
Yeah.
But I've done that too, where I'm like, look, dude, you're at a 580 on Credit Karma. Chances are you're lower than a 580 on our credit report. So let's send you over there right now to see if there's something that can get you to a 650 before I even run it, because I know that inquiry can drop you even more.
So something that I tell like the real estate agents that I work with directly, because I'll go hang out with them and or visit, maybe go to their sales meetings. The one thing that I like to deliver to them in value is say, hey, look, you guys are on the front lines. You guys are talking to our prospects more than anybody. And so the number one question that I want you to be asking these people is, what is their Credit Karma score? Because everyone's technically going to have an answer. Most people are going to have a Credit Karma.
If they say I don't know, is they don't want to tell you.
Yeah, and so if you look at their Credit Karma, they tell you what their Credit Karma is in real time. It can give you a really good insight into what kind of prospect you have. So Credit Karma is accurate in the sense that if the collection is there, the collection is there. Where it's not accurate is the credit score is not what the mortgage lending score is going to be. But if someone tells you that their Credit Karma score is in the mid 600s, right, say 640 to 680, that's a pretty good prospect for you. That means that person is likely very close to being ready or is ready. And the only limiting factor for them is going to be credit card debt. If you have a client that is on Credit Karma and their scores are 640 to 680, their only problem with their credit is they have credit card debt's too close to the limit. But if your client, your prospect that you're talking to is in the low 600s to high 500s, then this person might be like a 4 to 6 month prospect, because they probably have collections that we need to get through, some bad stuff that we need to figure out. And so that's a 4 to 6 month client. And then if your prospect on Credit Karma is like 550 or below, that means that person has recent delinquencies. They were late on their car payment in the last 6 months. They were late on their credit cards in the last 6 months. So they might have some financial instability there that might make this prospect more of like a 12-month type of deal. And so, but it's just all about understanding where they fit into your pipeline, right? So it's the same thing. If you have your Credit Karma, you're listening, my Credit Karma is 500. It's not no for now. It's no for now. It's not no forever. We can get you probably in like the next year. If you got a 600 on Credit Karma, you might be ready in 4 months.
Yeah, and a lot of times I've seen. I talked about this yesterday on my Instagram. It's a lot of times it's debt. Like people are at, and I've seen it. I mean, even myself back when I talked to you about this in the past, but I made the stupid young mistakes that a lot of people make. I don't even know do you know of a percentage of people that are in collections when they're like 18, 19, 20?
I don't, but it's significant.
Or like late payments or whatever. You know what I mean? So I made the stupid mistakes, right? And when that happened, I paid for them 5-6 years later, right? Because you just do minimum payments because you don't care. You pay one card off, and then you want to go get a TV, you get it on credit, right? Nothing wrong with credit cards, but they're dangerous.
Yeah.
Right. So then, I finally years later, I started making a little more money, whatever. So I was like, I'm gonna save up and I'm gonna just pay them all at once. Right. So I did that. And my credit literally like increased by like 100 points.
Yeah.
But because I had like 4 top credit cards.
But you also were never late.
Yeah.
Yeah. Because if you had a bunch of late payments and you paid them all off, it would not have gone up that much.
Yeah. It was just minimum payments on 4 cards. So they never went down. So from what they started to what I paid off was pretty close to the same exact amount. So, but again, it's young. It was a young, the young mentality, whatever. But like I'm saying, I saw it in firsthand. So it's not like I'm making this stuff up, and I can't make this up. You know that having your balances topped off or even over like 30% drops your score.
Yeah, I call it leaving points on the table. So if you come to someone comes to you and they have a balance on their credit cards that's over 30%, or I don't even want to say that because then people are going to think 30% is the magic number. It's not. But if someone comes to you with a balance on their credit card, they're leaving points on the table, and the higher the balance, the more points that they're leaving, right? So they show up here and they're using 60% of their credit cards. They're leaving 40 points on the table, and those 40 points you can grab them if you just pay off those credit cards.
Which can obviously be hard if you're talking about $10,000. Well, that's very hard. But even like people don't understand that if your credit card limit is $400 and you have it at $400, right? And you drop that to 100, which is 25%, that can still help, right?
Big time.
So you don't have to have humongous large debts. You just have to keep your utilization as low as possible.
It always translates into a percentage. So the person that has a $400 credit limit is the same concept if you have a $40,000 credit limit,
and
right?
You have it at $30,000 or whatever.
And you owe $30,000 on that $40,000 card. You're at the same percentage that someone with a $300 balance and a $400 limit is at. So the credit score doesn't understand dollar amounts. It thinks in percentages.
Gotcha.
So if you're at 20% utilization, you have a better score than someone that's at 80% utilization. And the real thing is people are always like, well, what should I do? Well, where should I keep them at? Should I pay them off every month? Do I pay them multiple times a month? Do I keep them maxed out and pay them off? Do I make minimum payments over an extended period of time? People complicate it so much. It's so simple. And I always talk to my client. I say, hey, look, do you know anybody that has really, 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 really good credit? And they go, yeah, my grandma, my mom, my uncle. Okay. Do they have credit card debt? They're like, no, they have no debt. If they owe something, they like to pay it off right away. And I was like, that's what people with really high credit scores do. They don't carry debt. And if they do, they try to pay it off as soon as they can.
Well, that's like, boom, right? Like
800 cup.
Mind blowing, right?
Yeah.
So it's almost impossible, and you know this better than I, for someone 20 years old to have 800 credit score.
Yeah.
Unless you're like on authorized users of 20 account. But you know what I mean? So what I was going to get at is that like, if I compare myself to my dad, no credit card debt whatsoever. If he does, it's like a $14,000 card and he has $200 on it.
Yeah.
You know what I mean? But what happens a lot of times is that, for example, even again, I'll relate to myself. I had at one point like 8 credit cards, right? And I stopped using like 3 of them, and then I stopped using 4 of them. Right now, I only use 1, and let me tell you why. Because it's my Costco card, right? So I pump gas with it, and at the end of the month,
4%.
pay it off. Yep, boom, boom. That's what I do. And then these other cards start to get canceled out.
Yeah.
So that's also not good for your credit, right?
Kinda.
So that's kind of where it's like I need to know where to balance. So I think, again, you can answer this question for me. Is let's say I have 5 credit cards, $1,000 each, but they're all paid off, no balances.
Okay.
And I have one that's $10,000. And I usually only use this $10,000 because it has the highest balance, which you don't have 10 and then 1. They're usually pretty similar, right? What I'm trying to get at is that, like, is it better to have a bunch of accounts that are paid off, or is it better to have one with a really high limit?
It doesn't matter because the way that your utilization is calculated is overall. So
Okay.
the credit system is going to add in all your limits, add all your balances, and that's your utilization. So sometimes you could be using some of the lower limit cards, but you have a big limit there that's going to offset.
Gotcha,
Right?
gotcha,
So
gotcha.
it'll make the number be lower.
So use the one that gives you the most points.
So a lot of people use credit card for points. I mean, that Costco card is my favorite as well. It gives you 4% back on gas, which is really, like, right now the only thing that makes gas palatable. But
We're all gonna go electric soon.
yeah, and so but Costco Citibank card is pretty good because of its rewards. And I like to think of it, and we're not really like. We're no Dave Ramsey's. We're not going to be giving people at Innovative Credit Solutions like them financial, like, oh, don't have credit or don't get a loan, right? But really, the mindset is that credit cards is not extra money. And the moment you start using them for extra money, then that's when you start to get into trouble. So the credit card should be used for things you're already going to buy: gas, food, right? Not dinners every night, not sushi every night, but groceries. stuff that you're already going to buy for, so that you're not spending that as extra money. And so that way you're going to stay ready. So your credit card balances are always low, or they're always in a position where you can pay them off quickly in case you need to use your credit.
Yeah.
So that's really like the mindset that we have.
And that's the biggest mistake that everyone makes, right? They use it as extra money.
They use it as extra money.
I think everybody who goes and applies for a credit card, it's like, I want to make this big purchase. There's nothing wrong with, like, let's just say I want to make a $5,000 purchase, and I have $5,000 in my bank account, but I'm like, well, I'd rather get it on a credit card and make payments on it, and if I ever need to pay it off, I have the money to pay it off. You get me? Like, I don't think that's bad.
No, not at all.
But like, I only have I make $2,000 a month, but I'm gonna go get credit cards and top them all off with stuff. I'm gonna go to Rosarito. I'm gonna go do this. That's, again, young mistakes, right?
So you finance your lifestyle. Here's where that same concept you just said, where I think it gets wrong. If you're going to be using your credit, if you're going to go buy a car in the next month, if you're going to try to buy a house in the next month, and you decide to max out your card, that's a terrible idea.
Of course.
As long as no one's going to be looking at your credit, because you're not going to be needing it for any time soon, you can technically use your cards. You're not going to have any long-term consequences for having high balances. But the moment you need your credit and you're not able to pay them off quickly, you kind of just like shot yourself in the foot, because you're not going to be able to use your credit, or at least you're not going to obtain that favorable financing that you're trying to get. Maybe you don't get that 0% on that car loan, or you don't get that great deal or down payment assistance for your mortgage loan, etc.
And in the car industry, just speaking with the managers the other day, they're way more like tiered, right? Like for leases, right? If you're in this tier, you get this rate. If you not rate, but what do they call that? The money factor. So like if you're at a 700, you get this. If at 680, you get this. If you're at a 660, you get that. So like the difference between you being at a 660 and a 680 or above is literally one paid off credit card.
Yeah.
I mean, not that simple, right? But you know what I mean.
I think the point is, credit cards can be very bad if you don't understand them, right? So the main goal is to make sure you understand, okay, this is how it works, because there's so much misinformation. There's so many people that think you have to have a balance on them in order to build credit. They're like, how am I going to build credit if I'm not using it? Yeah. It doesn't work that way, right? The way that it works is all it cares about is if you're making your payments on time. It doesn't care if you're using your credit cards. The reason why you want to use them every once in a while is so that they don't close them out, so you don't use that available credit. Yeah. There's no magic number of you got to have 5 accounts. You got to have 1 account, 10 accounts. Like, there's no magic number there. Technically, the recipe that we lean on as credit consultants when I'm helping somebody become mortgage ready is I want them to have at least 3 open active accounts in good standing. 1 credit card could be it. 1 car loan, 1 student loan. 1 child support account could be it if you're paying it on time. A credit card and a loan, right? Any combination of 3 accounts can help you be mortgage ready. So that's like part of the recipe number 1. You got to make sure we're using 3 open active accounts. It doesn't mean you got to be maxing out your card every month. It just has to be there, open and available. So that's like the first requirement. The second requirement that I look at is I need 12 months with no lates. Like, I need 12 months with no lates. The first thing I look at is, when was the last time they were late? Oh, they were late 6 months ago. They're going to be ready in 6 months from now, because that's going to be their 12-month anniversary of no lates. If you're late along the way, your 12 months start over. Right? And so I drive that point home to people, so they go, dang, the lates are that bad? Like, yes, lates are that bad. And if you're late again, you're going to kick the can down the road another 12 months. And then no collections. You can't have anybody on the report saying that they let you borrow money and you didn't pay them back. Yeah. We got to get rid of them. Now, do we got to pay for them? That remains to be seen. Can we fight them off? A lot of the times we can, but we have to understand like where we're at and where we're going, so that we know, okay, this is the end point of the credit. And so that's how we end up charging people. I'll say, hey, look, you got 5 accounts. I'm going to fight 3, negotiate 2. I'm going to charge you this much, and I'm going to break that up in a few payments while I'm working with you, right? Gotcha. And most of our clients are with us 4 to 6 months. Some cases are less. Some cases are boom, in and out, 1 month, and some, you know.
A lot of times it's how much you're willing to spend, right? If like, not how much you're willing to spend, but how fast you're willing to spend it.
Right.
So let's say, hey, it's going to cost you $1,000, just throwing a number, or $100, whatever. You know what? I don't have $100, but I can give you 20 a month. So now it's going to take you 5 months, right? Because you need to pretty much.
Yeah. So
not that simple.
If we need to negotiate some debt, and I got to wait for you to get the money together, then that might extend the project a little bit. And so that happens all the time. I mean, most of our projects, we work with our client as far as their budget is concerned. They'll say, hey, right now I got this amount of money set aside for debts. And so I know, okay, I'm not going to make an offer that extends my client more than that.
Gotcha.
And then once we, boom, used that up, got them some deals, paid some people off, got them off the credit, then we wait for them to basically re-up and say, hey, I got some more stash away, go for it, I got this much now. And we rinse and repeat until we're done with all the bad debt that was supposed to be gone.
So to wrap it up, one thing that I do want to make sure to put out there is that a lot of times what I see happen is I send you a client, you consult them, I'm going to go through with it, let's do it, right? You negotiate, you do your job, and then hey, we settled all this for this much. Can we collect the payment? And they disappear from the face of the earth. It happens all the time. I see it happen. You probably do see it happen way more than I do, right? Unless it's just my clients. but you get what I'm saying. So don't let that happen because what happens there?
Well,
in regards to their credit.
The debt doesn't go away, and we lose leverage if we ever try to do that again.
Because again, they log everything.
We won't get that deal, but sometimes we won't get that same deal again. I don't like to negotiate things twice. We do our best to prevent those situations, and so we don't hold clients' funds, right? So a lot of the times, a lot of debt settlement companies, they'll hold your funds in a trust account. We don't do that because trust accounting is, we're going to have to charge the client fees for holding their money. Yeah. And I think that's pointless. But so we try to do our best to limit those by establishing a budget up front. How much money do you have available right now for this project? I have this much. All right. We're not going to go over that much. And so we do that to try to limit these circumstances where that happens. But it does happen. I mean, it does happen. We do our best to limit that because we deal with these debt collectors all the time. We need to have solid relationships with them in order to continue to get solid deals for our clients. Of course. We can get deals for people that people can't get themselves, number one. And a lot of debt collectors don't do deletions unless it's us behind the deal. And so that's super important for us to preserve. That's because of the years that
you've been working with them and established the relationship.
Correct.
So, all right. So let's go ahead and get to the giveaway, my boy. What are we doing?
So we have consultation fees, and so we're going to waive all consultation fees for anybody that mentions the podcast.
As long as the video exists?
For as long as the video exists. Okay. No limit. That's a $45 consultation fee for one person, $60 for a couple. You mentioned the podcast. We got you. Okay. Right? And somebody, you decided the winner, is going to get a $50 Starbucks gift card.
A $50 Starbucks gift card. So how about we do it for the first person that comes in and starts repairing their credit?
Sounds good.
So the first person that contacts either you or me and says, I saw your guys' podcast, I want to start credit repair, and they actually initiate the process, they'll get a $50 Starbucks card and the free consultation.
That's a lot of coffee. Yeah.
That's a lot of coffee.
Let's do it.
All right, let's do it. So sounds good then. All right, my boy. Well, thank you for being here. And if you guys ever have any questions, I'll put your info down here. That way they can reach out to you directly. You want to tell them your phone number and email just in case they're just listening?
So my number directly, 661-369-8133. Again, that's 369-8133. You can call or text me there anytime. And my email, just my first and last name, just my amoreno@icscreditfix.com.
Okay. amoreno@icscreditfix.com.
Yeah.
Okay, sounds good. Well, see you guys next time.